everybody in the entire financial world is short upside calls on crypto, right? What that means is the more the price goes up, the more regulation changes, the more they have to get involved. I've seen a setup once like this before, which was the launch of the GSCI Commodities Index back in the late 90s. And basically, nobody had commodities in their portfolio. Everybody went to about 5 to 10% weighting, right? The amount of buying was in the hundreds of billions of dollars. The magnitude of what needs to happen here and the fact that everybody's short means that over time, they all get flushed in. And all the conversations I have are with the biggest financial institutions on earth, whether it's the sovereign wealth funds, the biggest asset management firms, the biggest family offices, the biggest pension funds. I mean, it's on everybody's radar screen. And incrementally, every bit of news you get that's positive on regulation, or somebody like BlackRock showing the way, or somebody like Texas Teachers showing the way, or somebody like Fidelity showing the way, makes people braver and braver. You know, when you look at what Goldman is doing, JP Morgan's doing, I mean, you're giving confidence to more people. All they need is a bit of price action, and they'll be in. And
I would just add, if we can pull up the chart here, you know, this all helps the adoption curve, right? So if stable coins are regulated and are deemed safe, and we don't have the headlines about stables that we had, you know, not too long ago, and the space gets legitimized, then I think maybe investors will have more confidence that the network effect, you know, the adoption curve of Bitcoin, which has followed, as you can see here, you know, a number of historical S-curves, whether it's internet usage or mobile phones or what have you. I think as the space becomes legitimized and gains more scale, I think more and more investors might start to feel comfortable that the promise of this expanding adoption curve actually can be fulfilled. And you can see here, right? So these are a couple of different models that I have. One is the S curve, or a modified stock to flow curve, and the other ones are two demand models. You know, we're below all of them, and of course we had a big crypto winter, a lot of deleveraging. You know, it's kind of par for the course. I think the space is pretty washed out, as Raoul said. You know, everybody basically is either short or at least not long, and so I do think there's a lot of potential here. But as you know, after yet another crypto winter, if the space feels safer, if the water feels safer to go back into, more and more people will start looking at the promise of this adoption curve. And as Kevin said, you know, the dollar stables, the dollar actually getting cemented as the reserve currency, which of course is the opposite of what a lot of Bitcoin maximalists have been saying. But I agree, and I think it's absolutely correct. I think it will help, you know, fulfill the promise of this expanding.
It's kind of weird. I don't even look at the Bitcoin price anymore. It's ETH.
Me too.
And the moment that the merge
It's
happens,
a good segue, but you've got to remember, we've been talking about the merge for 5 years. And
okay.
So, you know, let me be the skeptic. This is my largest position right now. ETH has moved up and put it at the top of the heap of my 32 positions. I'm a skeptic till I see it happen, because you got to think about who loses in the merge, you know, and if you're a miner right now, you're not loving this merge idea, and there's a lot of capital tied up in that. And so when it happens, I'll believe it, but we have seen this thing punted down the road 5 times. So what makes you so confident it's going to happen?
Okay, so let's quickly talk about that. So yesterday they moved on to the last of the testnets, which is called the Gurley testnet. That was a successful move. So pretty much they've gone on all the testnets and everything's worked, which kind of means that in practice, in theory, everything works. Now, I agree with you that the miners have got a lot to lose, and that's why the miners are now forming this coalition to actually fork Ethereum. So what you're going to get is you're going to get an ETH proof of work, and you're going to get an ETH proof of stake chain. And that's currently what's happening. So
is that a good thing?
Okay, so I'm not sure that that's a good thing, but what we know for sure, let me just give you the facts. So right now, there's a derivative of the proof of work Ethereum, which is trading at 3.8% of the value of the proof of stake Ethereum. So what people are forecasting is that the chain will split. You'll get a proof of work Ethereum and a proof of stake Ethereum, and 96% of the value will lie in the proof of stake Ethereum, and 3.8% of the value will lie in the proof of stake Ethereum. Now, Circle, USDC, USDT, and a whole lot of others have all said that they're going to support the proof of stake chain. because you can't support both, because you can't have your coins on both. But yet there is 4% value in the proof of work chain. Earlier this week, that was 8%. So the value of the proof of work chain is coming down. Look, right now, the futures are pricing the merge to actually happen on time, which is quite ironic because anyone who's been around for any amount of time always knows that Ethereum is delayed on things. But I mean, these are the facts right now. This is what the market's talking about right now. Raoul, what do you think?
Some of this is causing havoc in capital markets around data centers. I want to point something out here that I think we haven't touched on. And again, I'm tracking this from indexers. So if one of my core businesses is to index for sovereign wealth, 70% of capital that's invested around the world, and it may be, when we measure it again, 75%, is in sovereign wealth and pension. And so I can report to you faithfully that they own no crypto, zero. And so for all the excitement, and the reason they don't is they don't have any infrastructure to be compliant. It's not just that they're not allowed to because it's not regulated. They have no infrastructure to market. And so that their compliance departments can monitor whether they're over-levered, whether they have whatever their mandates are. Let's say you're maxed out at a name at 5%. They don't have any infrastructure to make that work like a stock or a bond. They're working on that. So is FTX. So is Binance. All the major trading platforms are trying to provide that infrastructure. But as it stands right now, last year, up to just before the correction, they were using public Bitcoin miners in the U.S. as a proxy to own Bitcoin because it traded in direct correlation. And I know that because I indexed for them. And so I'll never forget this. This is crazy. We were indexing. Other indexes were doing the same thing. The indexing business is about making 3 basis points. If you're an oil-rich country and you're bringing in $500 million US a day, the only place you can put it is the S&P 500. You don't move the market with that. And so at the end of the day, they'd say, okay, index to S&P, X oil, X airlines, because most of those countries own their own airlines. So, and they don't want any oil because they got plenty of oil. So when it came to Bitcoin, they said, look, we want 50 basis points. Come up with an index that is a proxy to the risk on Bitcoin. Bitcoin's the only one they care about. And so everybody designed these indexes. Now, the morning the SEC memo came out calling for auditors to sign the carbon credit claims. In other words, if you're a S&P 500 company and you say, look, I'm carbon neutral because I buy carbon offsets, well, the SEC wants you to sign that because everybody knows carbon offsets are bullshit. And if you're a polluter and you say you own an acre of the Amazon, that's BS. Now, why would that matter to Bitcoin? Here's what happened. Within minutes, everybody that was in Indexer got a phone call from Sovereign Wealth saying, dump every public mining stock in Bitcoin you've got because none of them are going to be able to pass this audit. It's never going to work. And they are agnostic to price. We were selling into declines of 20% an hour. And I didn't want to do that, but we did it. You go look at a chart of a Marathon or a Hut 8 or a Hive. That was the indexers dumping those stocks. And now there's no way they're going to give a proxy for Bitcoin because half the world won't buy them because they're polluters. They're dirty miners. So now you have to do mining with hydro or you have to do mining with nuclear power. And the biggest investors in those facilities, like the one in Norway, there's a company called BitZero, private, is the UAE. Same with North Dakota. The Burgum announcement last week, that old nuclear facility that's been on the market since 1975 just got sold to BitZero to turn it into a giant, clean data center. So new money moving into it, which I say is bullish for Bitcoin, because at the end of the day, the highest return when you're stabilizing a giant $600 million data center before you sell it to Microsoft is you rent it to Bitcoin miners. So you've got these massive facilities being built. Another indice, which I think is a foreshadow of demand, because when we get policy on Bitcoin and it gets indexed to 1% in a $900 billion fund, that's really good towards getting that price up to 100,000. That's the only way you're going to get it, because if there's volatility, you've always got the underlying bid from the sovereign wealth fund. You have to be bullish if you believe in regulation. That's my point.
Let's talk about the ETH, because I think, Raoul, you touched on the ETH merge.